I do not want it to be transcripted. I'm not sure is it transcripted or not. Let me. Okay, I hope that Honey will join us soon. Still at meeting. Okay, so when you say that inventory here, right, we are going to look at what are the journal transactions or the journal entries that you have to record when company purchase their goods and later they sell the goods to the customer, right? And then we know that when company purchase goods, all right, these are the normal transactions that have to do, all right? So that will involve account, what we call account inventory. Right, so when you purchase your inventory, right, it will involve your inventory account, means that there's an increase in your inventory, and inventory is your asset. And when there's an increase, definitely there will be a debit in your accounts. Yeah, so you're going to debit your inventory, but at the same time, why is still not? Okay, Honey is here. Right, but remember that when you purchase, either you pay cash, so you have to credit your cash, but then if you create your accounts payable, you're going to pay that later, then you're going to credit your accounts payable. So is that clear? So let's say that, for example, here, whenever you purchase, what will be the transaction? Anyone? What will be the entry then? It will be, you involve your inventory.
Okay, in this case, if you purchase anything, it will be two cases. If you purchase by cash, so inventory will be debited and cash will be credited.
Yeah, so you debit your inventory and credit your cash,
Yeah,
or
if
you
the
credit your
cases,
accounts payable.
yeah, if the cases we are paying later, so that means it will be credited to the payables of the company.
Yeah, so you're going to debit your inventory,
Yeah,
credit your cash, or sometimes you open up your accounts payable.
payable. Yeah.
Right? So that will be the entry when you purchase inventory. So in this case, it's very straightforward, right? When you sell your inventory, so it means that when you purchase, inventory increases, but when you sell your inventory, then your inventory will decrease. So the item here, when you make a sales, then you're going to have a entry where you have you are going to debit. When you make sales, of course, you will receive cash, or if you going to sell, if you sell it on account, right? So you're going to create your accounts receivable, because you're going to receive the money later, not now, but then you're going to credit your inventory, right? And remember that this inventory, you're not going to credit your inventory here, because you're going to credit your sales. Yeah, credit your sales, because this one you're going to record how much is the sales of the inventory at the selling price, and how much cash you're going to receive from your customer, or how much cash you're going to receive later from your customer. That will be your accounts receivable, right? Remember that this one is at the selling price. But when you look into later, all right, you also have to do another entry, what we call, you're going to debit your cost of goods sold, right? This is the how you want to record the credit of your inventory. Yeah, so when you make a sale, there are two transactions involved. One is to record the sales at the selling price, and then you also want to record the movement of your inventory. So the movement of inventory, when you make sales, there's a credit of inventory, but you're going to record that also. You are going to create one account named cost of goods sold, or COGS. Have you heard of cost of goods sold account? right? So the cost of goods sold, just like the name, is the cost of the goods that you sold. Yeah. So you're going to record this in order to see later what will be your profit, because you're going to compare your sales and your COGS in order to see whether you make a profit or not on the on the uh, on the inventory. So later you're going to look at the difference between your sales minus your COGS, and this will give you a gross profit, right? So you have to know this formula, right? Sales minus COGS will give you gross profit. So for example, if I say that sales here, my sales here is 1,000, and the cost of the inventory that I sold was only 400, make it 600, right? So the inventory credit here is 600, and then you're going to receive from your receivable of 1,000, which is the selling price of the good that you sold. So based on this only, you see that the sales that you make is, how much is it? 1,000. But how much is the cost of the good that you sold? Anyone? It's 600, all right? So if the one inventory that you purchase at cost 600, but you make a sales of 1,000, then you know that there's a gross profit of 400, right? So this is more important because you want to look at the performance of the company, whether from the buying and the selling activities, are the company making a profit or loss. All right, so when we call this one, we call gross profit. All right, it's not a net income yet. It's not a net profit. What we call gross profit is only looking at the sales and the cost of goods sold. Are you so far? Are you okay? Tasni?
Yes, madam, I have a lot of
Yeah.
catching up to do. I will try.
Yeah,
I
never
will
mind.
try my
Right?
best,
But it's
yes.
just that whatever you have today, you must be able to absorb because you don't have much time. Yeah.
Yes, yes, madam.
Yeah. Try it.
Inshallah.
Right? So these are the new accounts that we introduced today: sales, right, and COGS. Sales means that these are the accounts that you create whenever there's a sale of inventory to your customer, and sales accounts is always at the selling price. The other one is what we call inventory account, is that the inventory, the movement of your inventory, the in and out. So whenever you purchase your inventory, you're going to debit your inventory, right? But if you make a sale, then you're going to credit your inventory. And inventory is your asset. All right, and also from this simple transaction, you will be able to identify your gross profit. Looking at the sales minus your COGS, you have a gross profit of 400, right? Right. So remember that when you buy your inventory, is always at cost, and you're going to record that under COGS. When you make a sales, is always sales at profit. So that's why we sales at the selling price, right? So the difference between cost and your selling price is your profit, right? And talking about inventory system, there are two types of inventory system. The first one is what we call perpetual inventory system. The other one is the periodic inventory system. Right. So can you see the slideshow now?
Yes,
Yes,
madam.
Is it a full slideshow, or you only see the small one?
You can see chapter 6,
Yeah.
merchandising activities.
All right. So I just want to show you that what is a perpetual and what is the difference between perpetual and periodic. Let me. All right. Okay. Hold on. All right. Selecting an inventory system. All right. So there are two types of system. One is perpetual. The other one is a periodic. Yeah. So this one is slide number 17. So perpetual is normally being used by large company with professional management, right? So management employees wanting information about items in inventory and the quantities of specific inventory that they are selling. So means that whenever you use perpetual, you are going to have the information about your inventory in hand anytime. All right, because you're going to have what we call account, we call as inventory accounts, right? And these, all your inventory that you purchase will be recorded, right? Every time you purchase, every time you make a sales, everything will be recorded. So in order for you to use a perpetual inventory system, you need a computerized system, yeah. And if you use if you don't have a computerized system, all right, you may use a perpetual, but you can only have a low volume of sales transaction, right? So it means that if you do in a year, if you have a very small number of transaction that you have to record, then you can use perpetual if you don't have accounting system. But a high volume transactions definitely requires a computerized accounting system if you go for a perpetual inventory. Yeah, so without a computerized system, a large volume or high volume of sales will not be able to be captured, right? And at the same time, the perpetual system is also appropriate for companies that have merchandise which are stored at multiple locations. So again, I say that you look at perpetual is for big companies, all right? They have many branches, for example, they have many warehouses that stores their inventory, all right? And they make sales from different places. So having a perpetual inventory system, the company will be able to see the movement or how the standing of their sales and purchases at any point of time. Why? Because they have a computerized system which is integrated from one place to another, right? So this is a perpetual inventory system. The other system is what we call periodic inventory system, and normally it's being used by small companies, which is run by an owner, right? So the accounting records of inventories and specific product sales not needed in daily operation, right? They don't have to know, oh, how much inventory do I have today, right? They don't need that information, right? So what you need is that when you want to submit, for example, annual returns for your income tax purpose, you need to report, for example, because small companies, they are not required to prepare their financial statements, yeah, every year. But for the purpose of income tax, maybe they need to prepare a simple financial statements. So then only they need information about their inventory, right? So that's why they can rely on periodic only. And again, for this periodic is more suitable for companies with inventory with many different kinds of low cost items, right? For example, you're talking about small companies, a retail shop, right? They have so many different kinds of items in the shop, but each item is a low cost item, right? So they do not need to have a very regulated or high-tech technology, right, in order for them to monitor their inventories. And of course, again, for high volume of sales transaction and a manual accounting system. So if you have high volume transaction, but you are recording that manually, definitely you have to go for periodic, yeah. And all merchandise stores at one site only, right? There's only one site that you only have to monitor your inventory. So these are two. So remember that perpetual is for big companies. So it's see big company means that they are using accounting information system. They have the integrated and computerized, right? And then all these have multiple locations, high transaction, high volume, right? So that is perpetual. But looking at periodic, small companies, they only use periodic. They don't need information about the sales so much. All right, there's only one store, all right, and all those items are low cost items, right? So is that clear, the difference between perpetual and periodic? Right? So of course, when looking at current, all right, most companies are using perpetual because most companies are using computerized accounting system and easy for them to record. All right, for example, if you have a computerized system, whenever you purchase, you can just use a barcode, for example, in order to record all those transactions. Yeah. So that is on the difference between perpetual and periodic inventory system. Okay, coming back to here. So these are the two types of inventory system. All right. And then, all right, we also have the returns where we call returns, where we have a purchase returns, and you also have your sales returns. All right, purchase returns means that when you purchase from an accounts payable and you see that, all right, the goods are not suitable, or maybe there's a defective in the goods that you purchase, you return the goods to the accounts payable. Right, so that's a purchase return. So it's a contra to your purchases. So if you purchase inventory, the inventory comes in, all right, but purchase return means that inventory goes back to the accounts payable. Similarly, you have a sales return when you make sales to your customer and then customer are not satisfied, then they may return the goods to you. So that's what we call sales return, right? And we also have under merchandising what we call discounts, right? We can have a sales discount or volume discount. So it means that in order to encourage sales, right, company normally give discounts, right? So give discounts, in other words, it means that if you purchase a lot more, then I give you more discounts. Or if you can settle the amount due within a shorter period of time, I can give you a discount. So all this is to encourage more sales and to encourage settlement of amount due. Yeah. All right. So that is on chapter 6. All right. If we go into the PowerPoint, all right. This is the operating cycle of merchandising company. All right, you have your inventory, all right, or you start with your cash, right? Then using your cash, you purchase of your merchandise, and that merchandise is what we call inventory, and then you sell the inventory to your accounts receivable, and then you collect money from the receivable. Right. So remember that sometimes when you purchase your merchandise, you also create accounts payable rather than you pay out cash, right? So the cycle is that you purchase inventory either by cash or you create accounts payable, and then you sell the inventory to your accounts to your customer either cash or on account. So if you sell cash, you receive cash, but if not, then you're going to create your accounts receivable. And once you create your accounts receivable, you need to collect those amount due from your customers, right? So merchandising is that they purchase inventory which is ready to sell condition, but for manufacturing company, all right, they manufacture inventory and have a longer and more complex operating cycle, right? So when you do your management accounting later, all right, you may be looking into this manufacturing company, but at the financial accounting, all right, we are going to look into the merchandising activities only. Right, so the difference between retailers and wholesalers, right? Wholesalers buy merchandise from several manufacturers and they sell this merchandise to several retailers, right? So you have manufacturer, wholesaler, retailer, and then you have the customer, right? So you can have many manufacturers, you also have many wholesalers, there are many retailers, and then you have the customers. All right, of course, the numbers keeps on growing from the manufacturer to the customer. You can have one manufacturer, all right, and then wholesalers, a lot more retailers, and of course, sell to many more customers, right? Wholesaler means that they buy from the manufacturer, sell to another retailers, but retailers, they buy from manufacturers and sell direct to the customer or to the public. Right. So the difference is that now, right, in the previous class, when we talk about services, we only have your sales and then you minus your expenditure because there's no inventory. But when talking about merchandising, they see that you have a revenue from your sales. This is from your income statement, right? Statement of your profit and loss. So you have revenue from sales minus your cost of goods sold. See COGS there. And from there, you get a gross profit, then minus your expenses, or what we call operating expenses, then only you have your net income, right? So what is the cost of goods sold? It represents the expense of goods that are sold to your customers. So of course, the name is cost, right? How much is the cost of the goods that you sold compared to the sales, then you know what is your gross profit, right? So you use gross profit to measure the profitability of your sales transaction. Is this clear? Right, you must remember this, right, concept or the formula here where your sales minus your COGS is your gross profit, then only you minus your other operating expenditure to come to your net income. So this is when we have merchandising companies. For example, they have account receivable. This is what we call general ledger. All right, and then subsidiary ledger means that you are going to open up each of your subsidiaries. You can have many customers. So each customer will have their own accounts. Right, you have customer A, customer B, customer C. But the general ledger will compute the total from each of the customers. Right, so why you need to have a different account for each of your customer? Because you want to know at any point of time how much is the amount due from your customers, yeah, or your accounts receivable. So this is what we call subsidiary ledger, and the balances in the subsidiary ledger will be transferred to what we call accounts receivable. Yeah, so accounts receivable shows the totality of all your receivable. Right, so for example here, when you purchase 10 computer from Okawa Wholesale, it costs you $600. You purchase 10 units, so total is 6,000. Payment is due in 30 days. So when you say that payment is due in 30 days, you know that it's on accounts payable. Right, so you're going to debit your inventory and credit your accounts payable. Right? And then when you sold, all right, in for example here September 7, you sell 2 units of computer monitors for 1,000 per unit. All right, you sell to RJ Travel Agency. So when you make sales, all right, you say that on account. So whenever it says on account, it means that you're going to receive that later. So what account are you going to open up? You're going to open up your accounts receivable, right? But remember that this account receivable is at the selling price. 2 units, each one is 1,000, so $2,000. But remember that you also have to open up another account what we call cost of goods sold, because you also have to record the movement of the inventory. Right, so the inventory means that you're going to debit your cost of goods sold. How do you know 1,200 is the cost? Where do you get it from?
600 times 2.
Yeah, before the cost of the monitor is $600. So times 2 units, that's how you get 1,200 COGS, and you credit your inventory. Anyone knows why you credit your inventory?
Because we have to deduct it from the inventory because it
Yeah.
moves from the inventory.
When you make sales, so it means that your inventory reduces, right? There's a decrease in your inventory. That's why you credit your inventory account, right? And then what is this? Then you make payment, right, for the purchase the $6,000 that you purchased. So when you the Computer City, so Computer City is your accounts payable. So remember just now you make sales to your Computer City. So Computer City, sorry. Computer City is your company. Okawa is your wholesaler, right? Remember, okay, coming back. You purchase from Okawa. So Okawa is your accounts payable, right? You purchase 6,000. Now you make payment to your accounts payable. So that's why you debit your accounts payable, credit your cash of 6,000. Is that clear?
Yes,
right? So it's a bit confusing because there are names here. Yeah, so you must know who is your accounts payable, who is your accounts receivable. So here, Computer City is the company. Make payment to Okawa. Okawa is your accounts payable, right? So that's why you debit your accounts payable, credit your cash. So these are the journal entries that you must know, right? In order given a transaction, when company purchase Right, inventory, what would be the journal entries? When company make payments, what would be the journal entries? Yeah, so all this must be very clear. Yeah. And then you collect money 2,000 from your receivable, right? So your RJ travel is your receivable, so that's why you debit your cash, you receive cash, but you're going to credit your accounts receivable because you are reducing your amount due from your receivable. Yeah, so your account receivable reduce it, that's why you credit. Okay. All right, so now we look into what we call taking a physical inventory. How many of you have you heard of the word stock take? Do you know what a stock take is?
What, ma'am?
No,
Stock take.
didn't know. Didn't know.
Yeah?
Okay.
So this is the term, for example, companies, all right, once in a year or maybe twice a year, they will have to close their business in order for them to do a stock take, right? Stock take means that there's a taking a physical inventory, all right? So what they do is that they are going to do a physical count of the merchandise on hand, all right, in the business. So what they do is that they have to close the business. For example, you're talking about a supermarket, right? They have to close the one day just to do a stock take. So what is a stock take, or what we call taking a physical inventory, all right? This means that they are going to do a manual, right, counting of their inventory. So when they do manual, remember that all this you do debit your inventory, credit your inventory. So all these are on accounts. But physically, all right, you have to make sure that what is physical inventory is similar to your amount in the accounts. So that's why they need to do a physical inventory taking, right? In order to assure accuracy of their perpetual records. So what they do is that they're going to count, right, all items, inventory, depending on the types of inventory, all this, they are going to do a complete physical count, right? So when you do a count, physical count, you will see that there could be a difference between your physical count and the one in your accounts. Yeah, so when you recorded your inventory, the amount of inventory in accounts may not be the same as your inventory physically. All right, the reasonable amounts of inventory shrinkage, all right, are viewed as a normal cost of doing business. This shrinkage could be due to the breakage, it could be spoilage, it could be a theft, all right, or it could be because inventory expires, right? There's a expiry date, all right, so you cannot take that into account. So all these are done, and then only you see, oh, how much is actually my physical inventory that should be represented in the accounts, right? So whenever there's a shrinkage, most of the time there will be a shrinkage. Unlikely that your physical is more than your accounts, right? So your physical most likely will be a shrinkage, means that physical is less, the value of the physical inventory is less than your amount in the accounts. So this is what we call inventory shrinkage. So what you do when there's a shrinkage, and then you have to do a record whereby you're going to debit the cost. All right, for example here, when they make accounts on inventory, they found out that there's an inventory shortage of 2,200. So when there's a shortage, all right, then you have to record that accordingly. So you're going to debit, it's a cost to the company when there's a spoilage, when there's a breakage or there's theft. All this is a cost to the company. So that's why you're going to record that at the cost of goods sold, and you're going to credit your inventory. Remember that just now we have the same entry when there's a sales of goods. But here there's no sales of goods, just that there's a shrinkage in your inventory. So you're going to record that at the cost of goods sold in your inventory. Does that make sense?
Yes, Doctor.
Right. And then you're going to close, never mind, don't worry about closing your entries. Right. So you close your entries to so that you can prepare your financial statement. Right? Periodic inventory. So all this while that we have discussed, when you have your COGS and your inventory is under perpetual. But for periodic inventory system, remember it's for small companies, means that the transaction is simpler. Right? So for example here, January 6, Wagner Office Supply purchased merchandise amounting to 2,000 from Inkjet Solutions. So under periodic system, right, the difference is that when you make a purchase, you're going to debit your purchases. Debit your purchases and you credit your accounts payable. See, there's no account called inventory yet. Right? You do not create an inventory account. So you just record, oh, I purchased. There's a purchases of 2,000 from Inkjet Solutions. So you create accounts payable. So that's the first difference. Remember just now, under perpetual, when you purchase, you're going to debit your inventory, credit your accounts payable. But under inventory, remember, you do not monitor your inventory. So that's why they are going to put that under purchases. Right? No entry is made to inventory. Right? But when you want to compute what is your cost of goods sold, right, it shows that the accounting record of Wagner shows the following. So remember, this one is under periodic. You have inventory beginning of the year, you have 14,000. And during the year, you make a purchases. Remember just now you debit your purchases. So throughout the year, you're going to compute how much is your purchases made during the year. So in this case, you have purchases of 130,000. And all right, because periodic, whether you like it or not, you must do a stock take, because the stock take or the physical count will tell you that is your inventory at the end of the year. Whatever inventory that you have when you do your stock take, that will be your closing inventory. All right, because remember, you do not monitor your inventory. So in order for you to decide how much is my inventory as at this date, for example, in this case, the year end is 31st of December. So based on stock take, they say, oh, I have a stock take of 12,000. So that will be my inventory as at that date. Right? So I know that, all right, beginning inventory, beginning of the year, I have 14,000 inventory. So how do I get this inventory? January 1st is actually the closing balance of 31st December of the previous year. Right? The closing figure is the opening figure of the following year. Right? So it means that I started with 14,000 and during the year, I purchased 130,000. But at the end of the year, I only have 12,000 inventory in my stock. So can I guess, all right, what would be the goods sold? What would be my cost of goods sold? Right? So based on this information, remember this one is the periodic, is simple. If I started with 14,000 and during the year I purchased 130,000, it means that during the year I have 144,000 goods which is available for sale. Right? And then at the end of the year, I make a stock take and I found out that the inventory that I only have in my stock at the end of the year is only 12,000. It means that from 144,000, I have made a sales of 132,000. Why? Because from 144,000 goods available for sale, I only left with 12,000 in my inventory. Right? So it means that I have made a sales of 132,000. And this 132,000 is what we call cost of goods sold. So under periodic, right, the cost of goods sold is determined using this formula. Whether you like it or not, you have to remember this formula, because under periodic, the only way for you to know your COGS is by doing the inventory beginning of the year plus purchases made during the year minus your inventory at the end of the year. That's how you compute your COGS. Have you recorded this transaction, the formula?
Yes, doctor.
All right. Numan. Numan, are you here? Nurhani? Not here? Alia? Why is everyone is not here? Who is here?
I'm here, doctor.
I know Tasni is here, Hakim is here. I've not heard of Hidayat, Numan. Ali, I see
Hello, hello.
here, Hidayat.
Hello, 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 hello.
All right, Numan.
Yes,
All right,
ma'am.
looking at this, does it make sense to you what cost of goods sold is?
Yes, ma'am.
Do you
That is
understand?
basically the inventory and the what we are purchasing for inventory. For example, additional material, there is the cost of goods.
So you understand this?
Yes, ma'am. A little bit, I guess, an idea, something like guessing an idea. I am
Tasni, what about you?
basically I am revising the previous topic that I missed it. I am getting it little bit.
All right, very good. What about you, Tasni? Does that make sense?
I am trying. I am trying.
You just this one is a logic for a small companies, all right? How you want to decide on your cost of goods sold because they don't monitor the sales, or I mean not monitor the sale. They don't have inventory account. So what they do is that okay, I have this amount in the beginning of the year, and I purchase this amount 132,000. So it means that for the year I have 144,000 for me to make sales. All right, these are what we call goods available for sale. But when I do my stock take, I only have 12,000 in my account. All right, physical inventory is only 12,000, means that I must have made a sale of 132,000. Whether I really make a sale of 132,000 or not, all right, it doesn't matter. But I know that the difference is the cost of goods sold. Yeah, so you have to know this
I
formula
see.
because, all right, if you have a multiple choice question, it will come from this formula. All right, or the other formula that you must know is your sales minus your cost of goods sold is your gross profit. Very easy. All right, so this is another formula. This one is for your perpetual. So from sales minus your COGS is your gross profit. All right, but for your periodic, you have to find that COGS. So that COGS is actually derived from the formula where you have your opening balance plus your purchases minus your inventory at the end of the year. Okay, so later when we do our tutorial question, you'll be able to understand this better. Okay, but I want you to write somewhere. All right, I want you to write it down, this formula. Right, inventory plus purchases equals to goods available for sale, or you can call it as a GAS, goods available for sale minus your closing inventory, then you get your cost of goods sold. Right? Okay. COGS, you have inventory, purchases, never mind this one, don't worry about this. All right, this is what we call credit terms and cash discount. Right? So it's common that when manufacturer and wholesalers sell their products on account, so means that they are not selling cash. All right, so on account means that they're going to pay that later. The credit terms are stated in the invoice as this: 210 net 30. So how to read it? You read it as 210 net 30. So what does it mean when having 210 net 30? It means that, all right, remember that you are actually purchasing on credit. So 210 means that if you pay within 10 days, you get a 2% discount, right? But if you don't pay within 10 days, there's no discount, but you have to pay within 30 days, right? So that's what it means by 210 net 30. Right? Let me have Honey. Brother Honey.
Yes, doctor.
What do you mean by 210 net 30 here?
210 is the discount, and
Uh-huh.
10 is the days.
Yeah.
So basically, we have a discount for 10 days, right?
Yeah. So how much is the discount given?
Is it 30%?
Huh? 30%?
I'm sorry,
No.
I overlooked just now the one I was trying to remember.
6%, doctor.
Yeah?
No,
Where do you get the
6%.
6%?
Tu macam mana?
It's
In
from here,
two
from
times.
here, 210 net 30. It means that if you pay within 10 days, you get 2% discount. But if you pay within 30 days, there's no discount. Right? So it means that the 10 days, 210 means that you are given 10 days to pay. If you pay within 10 days, I give you 2% discount. But the maximum number of days you pay is 30 days. So, but if you pay after 10 days, then there's no discount. Right? So how do you know that you can get a discount or not? So you have to look at the date of your purchase. So when you purchase, for example, from your manufacturers, right, look at the date of the transaction and then what is the date of the payment. So if the payment is within 10 days, then you only pay 2% off. Means that you only pay 98% of that. The 2% is given as a discount. But if you pay after 10 days, then you have to pay the full amount. Contohnya, it's azan now. Shall we stop now and then come back at 8 o'clock?
Inshallah.
Okay, madam.
Okay, ma'am.
So come back at 8 o'clock.
Inshallah. Thank you, doctor.